Today we're going to be talking about how to avoid biases in investing. I'm Suruchi Jain. I'm the Managing Director and Founder at Opportune Wealth Advisors Private Limited. Thank you so much for joining us today. I'll begin with a quote. It's by Benjamin Graham. He's a famous investor and actually he's the mentor of Warren Buffett. What he says is that the investor's chief problem and even the worst enemy is actually himself. Not really investments or anything else, but it's actually, himself. So why is this topic so important? Behavior investing is actually at the heart of equity markets. You'll be surprised, but actually markets are driven by emotions. They're not driven by data. So while everyone thinks it's companies that are releasing, bad data in the quarter, or something has happened in the economy that has driven markets so down, but it's actually the human reaction to that data. Even if it's slightly bad, human emotion is what makes it worse. So markets are volatile due to irrational human behavior and extreme emotions. It's actually not really companies that cause, market downfall. And this image, this cartoon is a typical depiction of, markets at a high and markets at a low. When markets are up, everyone's saying time to buy, it's in the paper, it must be right. And in the end, when things are bad, everyone's, panicking, and it must be bad, it's probably time to sell. 5 main biases, and I would say, the first 3 and 4 are very critical, biases which each of us as an investor should recognize and try and even implement in our daily lives. So I'll try to give you an example each of how it shows up in human behavior in our daily life. Let's begin with that, with loss aversion. So loss aversion is basically going on the psychology of money. What the psychology of money says is that losing money is twice as painful as the pleasure of making a gain. And why is that so? So supposing you've actually lost 10 rupees or $10, you'll actually remember that for longer and it'll bother you much more than, making 10 rupees or $10. And that's just the way our human brain is wired, unfortunately. So recognizing that each and every human has this in them, that losing money, or basically not just in stocks, but elsewhere as well. Our human mind also tends to hold on to negative thoughts and feelings more easily. So if you've had like an argument or a disagreement with someone, you'll always remember those instances versus all the good times you may have had with them. So that's just a human cognitive bias. How does this common mistake show up in our investments? Right? Take the simple example of 4 companies that someone has invested in: ABC Co, XYZ Co, TXV Co, and FVC Co, right? And the returns are 30%, 10%, right? And for TXV and FVC, you're actually making negative returns, minus 10%, minus 20%. What's the action that typically people do? Typically, what people say is, oh, let me protect these returns. This company's up 30%, it's up 10%. Let me sell and capture the gains. And the ones that are actually not doing well, you say that, let me hold on so that it comes back to its original value. That's actually the wrong action. What you're actually doing is, if I would call ABC and XYZ as flowers in your portfolio, which are blooming and giving you good returns, you're actually cutting the flowers and watering the weeds. You're actually keeping the weeds, TXV and FVC, in your portfolio, whereas they're actually depleting your portfolio value, and you're cutting the flowers. Instead, what should you do? You should be watering the flowers and cutting the weeds. So what's the right action? The right action is to sell TXV Co and sell FVC Co and put that money into ABC and XYZ, because you want to hold your winners and sell your losers. So that is the common thing that one needs to go. So can an advisor like us help? So we are Opportune Wealth Advisors essentially do this, right? We manage portfolios for people And our main job is to avoid these biases. The biases that happen in the individual mind, we as an advisor are paid to get people out of it. So giving you real examples here, most of the examples that we talk about throughout the presentation, these are companies that are no longer in our portfolio. Some clients may have decided to hold on to them out of personal choice, but I'm sharing real life examples here. And a quick disclaimer, this is not an advice to buy any of these companies. So, please do note that. So, back in March 2019, we had entered Delta Corp, right, around 250, 240 rupees. And that company, we had a thesis around it that, things will grow and this is how it will pan out. But things didn't work out. At least in the stock price, it didn't work out, right? And we were at 170, 160 rupees. So we decided that, okay, let's cut our losses and put that money elsewhere. But you might look at this chart and say that, hey, you actually lost the upside. You sold at 160, 170, whereas you could have actually reached 200 and then you could have sold. The one thing that people don't realize is this time frame has an opportunity cost. So by exiting Delta Corp, we were able to invest in better companies, in the flowers and not the weeds, and reap better benefits in those 6 to 8 months versus just waiting for that company's price to come back up. It still didn't come back up to where we were expecting it to. But a common mistake for the for the retail investor would be to wait till 240. So the common investor would not have sold it even at 200 and lost this entire opportunity of investing in other companies that would probably be doing better. So take a loss and find the next flower to water is the way to avoid it. Let's move on to the next one. It's called anchoring. So what anchoring does is our human mind takes one data point, mostly like a prior data point, and that becomes the starting point for us to do all our analysis around that. Typically, this is what happens in trading as well, right? You entered a certain price at say 120 rupees, and then that becomes your anchor. So if it's lower than 120 rupees, you don't want to sell it. If it's higher than 120 rupees, you want to make more. So 120, your entry price becomes your new anchor, right? Because you bought at that. So ever been in a salary negotiation? That's a very simple example of anchoring, right? Whoever says the salary first, whether it's the employee or the employer, that's the first anchor. That's the basis of the anchor. And a salary negotiation can go up or down, based on that particular data point, or like a lot of people do, the prior salary. So all that is anchoring, a very common mistake. Let's see how people use this against us. Discounts. Use this trick against human rationale all the time, right? So if something's actually worth 300 rupees, they don't actually say that it's worth 300 rupees and buy it at 300. No, most people will not buy it. So what they do, they mark up the price. They make 1,000 rupees as your anchor and they say, hey, there's 700 rupees off. So why don't you just pay 300? What people don't realize, you end up paying 300, whereas you wouldn't have paid 300. And you end up doing that because your anchor is 1,000. So you think you saved 700 rupees, but you actually spent 300. Let's look at the common mistake and how it happens in our portfolio. Going back to a similar example like we did before, right? The ABC Co and XYZ Co, the TXV and FVC, all of these we bought at 100 rupees. So 100 rupees is our anchor, right? The new price of the top two companies is 130 and 150, right? And of the bottom two companies is 80 and 70. So if you were to go with a trading mentality, you would say, oh, 130 and 150, the price has really gone up so much. Let's just avoid buying these two companies. They're just already too expensive. This happens also with the PE ratio. If some of you track the PE ratio, people avoid buying companies with high PE ratios, whereas a PE sometimes just reflects the quality of a company. You obviously need expert opinion or a lot of years of experience to understand, what PE means high price and what means low. but just by the 100 rupees going to 130 or 150, people think that the price has already gone up so much, and then you end up buying the 80 or the 70 rupees one, because you think that, oh, it's cheaper now, I'm getting it at a discount, because that's how the human mind works, not realizing that maybe ABC and XYZ is trading higher because it is valued more. Maybe the company actually has better prospects, right? Whereas TXV and FVC, maybe their prospects aren't so good. For example, in the Delta Corp example, right? We didn't think that the fundamentals were in the right place, and so that's why we decided to exit. But a lot of people don't look at it, and I'm giving an example here so that it sticks in your mind. Essentially, when you're buying the cheaper companies, you're essentially you're essentially collecting trash, right? Trash is cheap, right? Your radhi goes at 10 rupees per kilo. So would you want to actually collect trash in your portfolio, or do you want jewels? Jewels will always be expensive. And how much is expensive? Of course, advisors can help. This again is a real life example where we had an investment in Bata, and we had bought it at around 1,300 rupees. And post the pandemic, things were in lockdown, everything was shut. It continues to be a great company. But for us, at some point, we felt that at 1,400, 1,300, okay, we might be making a slight gain. We don't want to anchor to this earlier price, because if someone was to anchor at that earlier price, and some of our investors did, and they had a really hard time selling it. But if you didn't have that anchor, and you actually look that at 1,400 rupees, where can it go from here? So every day reevaluating that, does this company have a future, and is it worth more tomorrow or the year after? So not every investment will become a winner. The idea is don't anchor to prior price, right, and exit at the right time. We exited Bata, and we found a lot more companies that we could invest in that have given us good returns and better returns than Bata also. Moving on to the next. It's called recency bias. What recency bias basically says, that the human mind has a tendency to overweight the most recent information. Just a simple example here. So if you see mutual funds, the average 5-year return and the average 12-month return, these are all numbers which are shared publicly by the mutual fund companies on their websites, on their, on portals like Value Research and other portals, Money Control. So when the markets were down, right, in the middle of the pandemic, I got a lot of questions. Should I continue investing? My investments are down so much. They've only just come back to their original value in March or April. I got a lot of those questions. I said, do you need the money right now? And if you don't need the money right now, then please don't pull that money out, right? The markets will do better in the coming quarters, in the coming months. And if you don't need the money, just let it grow, right? So, but the human mind has a tendency to stick to the most recent data, right? So recent information, supposing something that happened yesterday, something disturbing happened yesterday, you had an argument with someone, or someone did something wrong, that information sort of tends to circle in your mind, right? That's just the human mind. That's how our mind works. And so to give you like a really funny example here is of an ox, right? I don't know if any of you have seen this, but basically this is like a chakki ka atta, how this is made in the villages. It's basically the chakki in the middle, or the grinder, in which they put the wheat kernels, and they put an ox, tied to the post, and the ox just keeps going round and round and round the whole day, right? So that's how the information keeps circling in our mind, and it keeps troubling us and it keeps bothering us. So if there's a negative return, and all of these prior biases also come together, right? The negative return will keep eating up space in your mind, and it'll keep bothering you until you're like, okay, I'm just fed up, let me just sell it. So it's the human mind, it's a maze, and you should recognize that, okay, this is just recent information, but 5-year data says that this should be good investment, and so I should hold on or get an expert opinion, right? To understand, okay, is there something I'm missing? What is the problem? How can an advisor help, right? getting an expert viewpoint or perspective is important on your investments. Since most of us are busy in our daily lives, doing other jobs, not linked to the markets, working in an IT company, as a professional, running our own businesses, it's not important that always the do-it-yourself approach will work out. So what does an expert do? Right? Opportune Wealth also, we publish frequent newsletters. And what does it do? It gives a perspective. So just to give you an idea, in March 2020, right, when markets were at the bottom, what we wrote to our clients, and we've started now putting these newsletters on our website as well and publishing it on Facebook and LinkedIn. So definitely do look those up. We said this won't last forever, right? This year you will see maximum gains, keep investing, right? So we did give people that opinion. Some people who had the spare money, they actually ended up putting it in and they got fabulous returns. But others who were scared, with the recency bias in mind that, oh no, what if I lose my money? They didn't gain. They couldn't get themselves to invest, right? And in Jan 2021, when things were again up and bullish, and we also said this won't continue forever. This year, you may see a correction and invest with caution, right? So getting a viewpoint, get an expert viewpoint is important to avoid recency bias, and from that, information keeps circling in your mind. Let's move on to the next one. This one is called herd mentality. So this is like a funny image of basically, sheep jumping off a cliff. So this actually happens, right? What the image says, I don't know where we're going, but from the look of this crowd, it's got to be good. So if you've ever seen, gazelle in the African plains, or cows or buffaloes, what happens is if there's imminent danger in one part, of the forest or anything, and if it's a large herd, the minute they realize there's danger, like all of them start running in the opposite direction, right? And like that's what causes a stampede. So, if we were to actually put this in the real world scenario, like sheep could be jumping off a cliff if they feel like there's more danger on the other side. So humans also find comfort in following the crowd, just like sheep do. It might surprise you, but it's actually true. Just putting a common mistake out there, which is when markets are going up, right? I'm just going to walk you through this. You can read this as well. There are a lot of words here, but it's just how our mind works. When things are going up, they're like, okay, let me wait and watch. Maybe there'll be a correction. Maybe there'll be a correction. Then at some point, people lose patience. I can't wait any longer. Let me just buy now. Things are going up so well. Then at the peak of the market, you're like, oh, I'm so glad I didn't wait. You end up buying, and then after that, it goes up just a little bit, right? Before the crash is coming, but you feel like, oh, glad I didn't wait, right? And then things start to melt. Things come down, and then you're like, oh, I will use this correction to buy some more. So then you buy some more, right? But then the price of the stock continues to go down. And then in between, there's a little bit of a spike, and then you feel like, oh, like, great, this is confirming what I said, like that it was just a minor correction and now things are back. And then when markets really continue correcting, right, things may be bad, but our human behavior and the herd mentality, right, makes it worse for us. They feel like, okay, enough is enough. It's time to sell. I'm just getting out. So everyone just sells at the same time, which further crashes the market down, right? And then you say, okay, luckily I got out in time, not realizing that this is actually the bottom of the market. You should be putting money in, not actually selling. But people continue to sell. And that's because they're only looking at the price. There's a little bit of anchoring. You're looking at that price, 100 rupees, and now it's become 50. So now that it's below your, oh, it's cheap status, now it's like, oh no, I'm losing money. It's not just cheap and I shouldn't be buying more. That's when you really start panicking, and panic sets in and you start selling everything because you just want to salvage what you have. But that's not kind of like the right attitude and the way to do it. So when things start moving up again, you're like, oh no, I don't have any investments in the markets. What am I doing? What is happening? And then later on, someone can be like, oh no, I knew this would recover, and damn it, I should have just let my money be, right, from here to here, because things you knew would improve. So it's a combination of recency bias, herd mentality, and what's the way to kind of avoid this scenario is to actually stop and think, right? When there's sheep jumping off the cliff, wait a minute and say that, okay, something feels wrong. Maybe I shouldn't really be following the crowd. Maybe let me think for myself, right? The example to avoid, I'm going to give nothing against the traders here on the call. And we do have traders at, our partner firm who kind of help us execute the trades. But this is a very common thing. Traders are your advisors. A lot of people have traders as their advisors. People who trade in, trained out. But what you don't realize, very packed room, all right next to each other. And so there's a little bit of herd mentality going on here as well, right? If someone says, oh no, there's a large sell order, on example, say Tata Steel, oh no, things are going really bad and we should basically exit. So when one trader gets a big order, then he communicates that to everyone else. And there's a lot of herd mentality. Suddenly, if there's panic in this room, where a lot of our money gets traded, then you basically, all the traders are telling you, oh no, markets are down today, and they're following daily news and they're following the ticker minute by minute. So every time there's a downfall, they're like, there's a gas. Oh no, things are going down. Like you should sell. Or if things are going up, oh, you missed buying. So essentially, it's recommended not to have traders as your advisors. I'll also explain one more reason why. Traders sit together, so there's herd mentality, whereas advisors sit alone with you, right? They have your goals in mind. The other thing is the principal agent problem, right? Again, nothing against the brokers here on this call, but every time you trade up or down, the broker makes 0.2% on your trade. They have no skin in the game as far as your profits or losses are concerned. They are incentivized by the transaction taking place. So they will be recommending you, okay, why don't you buy today? Okay, why don't you sell today? And so not only are you kind of paying higher capital gains or losses, you're recognizing those gains or losses, they're making their brokerage, but they're also feeding in that herd mentality. Versus a lot of advisors these days have a fees, right, as a percentage of their assets. And Opportune Wealth also works like that. So the idea is the fees, yes, does go up over time, but it goes up in the same proportion as your assets. So if you have 1 crore and we're charging up a percentage of that, if we end up making you 2 crores, right, the percentage will be calculated on 2 crores. So one could renegotiate and say, okay, can you charge a lower fees? But the idea for advisors is to grow with the client, not to have them trade in and out and pay higher taxes. This brings me to the last one. This is called the confirmation bias. This is again a little bit hard to understand, but I'll try to my best to explain it. We accept information that confirms our prior beliefs and biases more easily than new information. So this image just shows you, right? There are 2 people speaking. This person already has like a set belief in his mind on any given topic. But here, of course, we're talking about investing. So for example, the ABC company is going to do fabulously in the next 10 years. So, but the fact is, supposing there's a fact here, right? Saying that profits were down 20%, and this person is telling you that, oh, no problem, things will look better next year. Then again, he tells you next quarter profits are further down, they're minus 30%. Do you still want to hold? Then we keep saying that no. You just disregard the new information. So there are objective facts, what you see, and what facts confirm your beliefs. You end up only filtering out what facts confirm your belief, and that's again a human tendency, right? Why do people again, not to go on a controversial topic here, but this is one reason why you end up marrying people with similar backgrounds, because a lot of these biases and beliefs are already there in all of us. So it's very hard to accept people with different kind of backgrounds and beliefs. So it's just easier because we are all living in confirmation bias, to have people with similar backgrounds to be married to or friends from that. So that's why there's a lot of groupism which is also formed due to confirmation bias. On the investing front, how does this play out? If you don't understand a sector, right, or you're too bullish on a company, you can basically lead to overweight on a particular stock or a sector in your portfolio. What's the way to mitigate, right? It's to seek contrary advice, to talk about your portfolio, right? Maybe you're an IT sector professional and IT is all you understand, so you invest in only that, right? And avoid confirming questions. So you should be aware that what are the questions you are asking. Am I only seeking information that is confirming what I believe? And if you really seek out the real facts and accept them, that's when you'll see, okay, maybe my portfolio is really overweight in one particular place, and that probably isn't so good in the long run, because markets go through different cycles and not every sector performs in every leg of the market. So having diversification always helps. How can an advisor help, right? So having a diverse research team can help eliminate biases. So this is true in mutual funds as well, right? There are a few mutual fund companies who basically pride themselves on the research team that they have. So we at Opportune are also really happy that we have a good research team. And so the whole idea is to share ideas, to talk about the companies, the sectors. So how do we internally as Opportune Wealth avoid this confirmation bias, right? Because it's a very common thing, is to track the market news daily, know what is really happening in the sector. Prices are tracked on a weekly basis. We don't track them on a minute to minute or a daily basis, because this again causes that recency bias. We review our forecasts and models on a monthly basis. So if you do it too often, that is also a problem, unfortunately. And then we listen to company management on a quarterly basis and revise our thesis and take action. So typically when we invest for our clients, there's only one action in a quarter, and most frequent is one action in a month. That's because typically compounding requires a lot of time. So one needs to be invested in companies and not be thinking ki aaj main kya bechu and aaj main kya kharidu. And that's like the trader mentality, because in India there is that trading mentality, and a lot of traders are advisors. But this advisory business is kind of just still growing, and it'll grow only when people understand what are the common mistakes. Just a quick recap and a quick introduction of who we are. I hope you found the biases helpful. I'll just quickly tell you who we are before we wrap up. So Opportune Wealth Advisors, we offer 3 products: equity investments, mutual fund advisory, and also financial coaching or financial planning. So our equity investments are research-driven selection of stocks. We have a full video on YouTube which discusses how we go about selecting companies. Please do take a look at that. Mutual fund advisory, again, this is research-driven selection of funds. We don't have a video on this yet, but if you write to us, we can definitely send you our methodology and our current recommendation of mutual fund lists. Financial coaching or financial planning, it's very behavior and goals based. It's essentially a new service we've launched just 2-3 months ago, where we're hoping to be able to coach clients into not making any of the prior mistakes that we just mentioned. Our equity research methodology is essentially picking out select industries where we think there is high growth potential. Within that, choosing winning companies with sound management and at fair valuations. Again, more on this on our YouTube videos. And just to share, if you avoid all of these biases and avoid churning your portfolio, getting in and out very fast, you can perform well. And so what we've been able to do, and these are all returns after fees and expenses, right? We have been able to outperform all benchmark returns, whether it's the Nifty 50 or the BSE 500. We've been able to outperform that on a consistent basis. And we've just completed 4 years of investing for clients. This year, 2021, we'll be completing 5 years. Just as a closing, wanted to close with a quote. Investing isn't about beating others at their game. It's about controlling yourself at your own game. This is by Jason Zweig. He's a renowned personal finance journalist. And with that, just a quick look at the disclaimers. We are not recommending any of the stocks that we mentioned in our presentation. And thank you so much for joining us.